We've been doing this podcast for 2.5 years now, and the most listened to episodes are always the ones talking about career and certifications in Treasury. So we decided to partner up with the AFP, the Association for Financial Professionals, so we can offer you a $100 discount code on all of the AFP's products. This includes, of course, the CTP, the Certified Treasury Professional, which is hands down the most renowned and recognized certification in Treasury out there. And of course, the access to the CTP exam prep platform as well. Check the link in the description to access to those discount codes and take your career to the next level. Oscar, thank you so much for joining us on the show. We would like to start by talking about short-term investments and its landscape. So could you maybe give us a brief overview of what short-term investments are, why they matter, and how treasurers should be looking at them?
Yeah, look, absolutely. And I think when the to take it back just a quick step, and exactly, so what is a short-term investment? And what is cash management? It is exactly that. It's investing. So you are choosing to place your money somewhere. So if you're choosing to place it in a bank deposit, you're taking on that bank's risk. You are taking on a degree of credit risk. You are in fact giving that bank an unsecured loan. So it's always important, I think, really, to remember that actually, even if you're just placing money on a deposit, it's not like it's actually locked away in a safe, right? As you imagine when you're a child and it's in a bank and it's in a safe, that's not quite how it is. You are lending that money to the bank. And I think what really has been popular for corporate treasurers has somewhat been dictated by what is easy, what's easy to get your hands on and what's easy to access. And really, that's been two things. That's been short-term money market funds, so your AAA rated liquidity funds. They've been around now since the 1970s. Maybe we'll talk about them a little bit later. But corporate treasurers use those. They've got great utility, same-day access, and allow treasurers to be somewhat flexible with their money. And like I say, there's portals for them. There's multiple different homes they can access them. And then, of course, everyone needs banks, right? Everyone needs to pay their staff, pay their vendors. So they're going to need to use banks. So having a relationship there allows them to set up term deposits. So they're the traditional ways in which corporate treasurers, large businesses, small businesses have managed cash. And if we look now at where we are in terms of a landscape, we're in an environment which a lot of corporate treasurers won't have experienced now for either the majority of their career or certainly not for a number of years, and that's high interest rates. And so if we look really at dollars to start with in the US market, the US T-bills are breaching 5%. And that's not happened for a number of years. And even if you look further down the curve, US bond market is out at 5% in the 10-year space. That hasn't happened for 16 years. So these higher for longer interest rates is an environment many corporate treasurers haven't had to deal with. And so all of a sudden, if you're sat on a reasonable amount of cash and you're not doing something with it in the short-term space, the opportunity cost is biting you. So that's the landscape. It's now more important than ever, I think, to do something efficient with your surplus cash.
And I mean, you touched on it there about the interest rates, Oscar. So given that, how has that impacted the overall short-term investment options available to treasurers? Like, what have you seen treasurers having access to and perhaps not having access to that they used to before?
Yeah, absolutely. So talking about money market funds, they're obviously a maturity transformed vehicle. So they're able to invest money out to 12 months and under in order to give a client a higher rate of return. So although the client's getting same-day access themselves, they're able to benefit from the curve. So benefit from those increased interest rates as you go further out. But what's very different now compared to what was the environment we were in for many years in sort of the ultra low interest rate environment was that the fact that if you are able to term out, so if you can, place a 3-month deposit with a bank or go into a longer dated product, there's benefit to be had there. And there's a delta between overnight products and those term products. So not much has changed in terms of what's available to treasurers over the last sort of 2-3 years in terms of the interest rate. But those products that are there, so term deposits and the like, they're suddenly more valuable. They're suddenly able to actually improve returns on a material basis versus their overnight positions in a money market fund or in a current account or something like that.
What about the Treasury departments that have abundance of cash? Are they just sat there laughing nowadays, saying, "Hey, look, this is what we were waiting for, and now we get to be the ones that are scoffing," instead of maybe 5 years ago, those were the ones that everyone was like, "Why are you sitting on so much cash? Like, money's cheap."
I think suddenly you can make your cash work harder, which is great. You can get a bit of a return, and if you've got, let's just say, if you've got 100 million sat in surplus cash, and you're able to make 5%, you're making 5 million on that, which obviously sounds great, but it's with the backdrop of inflation. So inflation's been as high as certainly I can remember for the last 20 years or so. Yes, okay, that there has been higher levels of interest rates historically, inflation rather. But we're suddenly in a higher inflationary period, and of course that is eroding the value of those deposits. Now, whether it's a good thing to be sitting on, extreme levels of cash, who knows, right? It's hard to play off the advantage of having that cash available to you, but then also being able to manage it and place it into longer term deposits. And we'll come on to it probably, but there's always a playoff between liquidity and yield. And of course, above all of that is security as well.
Oscar, thank you so much for all this. That's rather clear. I'd like to come back on a few things you mentioned. With the cash being more valuable because bringing more interest rates, whilst having a little bit more uncertainty, right, by investing it in the bank, because as you highlighted, it's an investment. You have a risk of losing it, even if it's low, and then you have to make a balance between the liquidity and the yield. Are companies and corporate treasury departments not tempted to just keep the cash in-house and potentially not to sit on it because it's valuable, invest more within the company? What I'm asking is the rise in interest rates obviously meaning that there would be a rise in short-term investments from within the company towards the outside world with third parties? Or does that simply mean that cash needs to be more strategically allocated, but not necessarily outside in short-term investments? What's your thought on that?
Yeah, I think it's really interesting. And of course, it will vary massively from company to company and what their own strategy is. And if you think about the way a company should and most do look at cash, you can sort of segment it into separate buckets. So you have your working capital cash, and that's cash you're going to be dipping into and using all the time. So you're using it to pay your staff, to pay vendors. It's going up and down like this. You're not sure exactly where it's going to be. So that cash has got to be into real cash products, so real overnight investments. So whether that be something like a money market fund or a current account in a bank. You then go into what you might call sort of excess cash. So this is the pool of cash that you have. Typically your working capital is not going to dip into it. So you've then got an option with that cash. Are you going to term it out 3 months? Are you going to term it out 6 months and go outside of cash and cash equivalency into short-term sort of investments on the balance sheet? That's where you've kind of got to make the decision as a company. And then you have the next sort of bucket, if you like, which is that strategic cash. So this is where you can take a longer term view. Where do I think we are in the interest rate cycle? Do I think I can turn this out for 12 months plus now and get a maximum return? Like, are we hitting terminal interest rates about now? So this is a really interesting dynamic that's probably coming into people's mind right now with the Bank of England just today. The 3rd of November. Is it the 3rd or is it the 2nd today? I always lose track. The 2nd November. The Bank of England's committee meeting today at the MPC announcing they are keeping rates where they are. This is probably an indication that maybe we're coming to those terminal levels. And so Treasury's got to start thinking about, well, if I've got this cash, if I term it out now for a longer period, I'm getting the maximum amount out of that. I guess it always depends about, how is a treasurer viewed? Are they there as a value add? Do they have this big pool of cash and their job is to try and make that work as hard as possible? Or is it all about just keeping it as safe as possible? I think it's somewhere in between. You've got to always prioritize the capital preservation, because if you lose that cash, the company may not be able to run. We know that cash is the lifeblood of an organization. So I think it's a bit of a here, there, and everywhere answer for you, Guillaume. But I think it varies. I think it depends on how you're bucketing up that cash. Is it in operational? Is it in strategic? Or is it in sort of that excess bucket, dependent on what you can do with it?
Yeah. Okay, makes lots of sense. Let's assume then that we are looking at third-party short-term investment tools. What are the most popular instruments for treasurers right now to park their cash in the short term, especially given the current context? I think you brought up the repo a bit earlier. Maybe we can delve into this type of instruments that are options for treasurers.
Yeah, absolutely. I think, it comes back to that old adage of SLY, so security, liquidity, yield. And I'd sort of like to throw in the fourth term there, which is diversification. Treasurers will always want to be able to be diversified, secured, liquid, and then get an appropriate level of yield. Now, what is popular, as I was sort of alluding to earlier, has been dictated by what is easy to access. So, you can easily access money market funds. You can easily access term deposits. In terms of other options that have been or are available to treasurers, something like a repo, this is usually an instrument which takes a lot of heavy lifting to access. You need to appoint your lawyers to agree your GMRA, so your global master repurchase agreements. There's a lot of work that goes into setting up those transactions. When you get there, they're great. From a risk-adjusted return perspective, not only are you, first of all, facing a very high-quality bank, but you actually then have this almost comfort blanket of collateral, which can be liquidated at any point given a default. And also, the way in which you're funding that bank from a regulatory capital point of view is very favorable to them, meaning they can pay a higher return. So you can be in this somewhat strange position of taking less risk, but getting a higher return. And that sometimes people struggle to get their head around a little bit. But this is, as I say, this is how the very large investment banks manage their cash. They always do it on a secured basis. I think if there was somewhere where you could access repo much more easily without any of that heavy lifting, this would be a very popular instrument because it kind of ticks all those boxes of security, offering you a way to manage liquidity risk. And we could talk about what liquidity risk is in a bit as well, maybe. And of course, it gives you an appropriate level of yield. But just to think really about diversification, I think it's really interesting, right? We think about diversification on one level really, which is just being diversified across institutions. So a treasurer might think like, I've got 10 banks. I use a couple of money market funds. I'm really well diversified. So if we think about the banks for a second, they're pretty linked. There's contagion risk there for sure. They're all open to the same sort of risks. We saw what happened with Credit Suisse when that was going on. Some of the other banks across Europe were looking a little bit on the edge. So there is a degree of contagion there. So are you truly diversified if you're only ever in banks? And then if we think about money market funds, yes, they invest across a number of different securities and do provide a decent level of diversification. But there's a limited universe to what those money funds can invest in. So if you're in 1, 2, 3 money market funds, you're pretty much just doubling down on credit risk to those underlying institutions. Of course, there's the utility they do provide that diversification. But if you are a corporate with high levels of cash, really opening up another money market fund, it's not adding any diversification. And so I like to think about diversification on those two levels. It's across institutions. So, spreading my credit risk, but also across asset classes. So when I say asset classes, sectors, right? So I like to think about the financial sector. So that's your banks, but then also governments and government agencies. So government-like risk. So do I have a way of placing money directly into the government or into an SSA? So a supra, sub-sovereign or agency. Do I have that facility? And then also is there something in my treasury policy that allows me to buy corporate paper? Because again, that is totally diversified away from those financial risks. So the same risks that apply to all those multiple banks, they're not quite the same when it comes to a corporate. So I think so long as corporates are thinking about, how can I truly diversify my cash? And they've got other places they can place it, which isn't just a bank or a money fund. I think they've got a pretty suitable policy there.
Is it something that you see companies investing in commercial paper? Like, is it something common? I'm wondering because if we consider banks being risky nowadays, aren't corporates even more? Like, is it something you see in the market?
So it is something we see, that corporates are buying other corporates' paper. That does happen. And, I'll talk about the difference between the US sort of corporate treasury market and UK/Europe in a second. But if you think about how most corporates view banks and their credit risk, they're using credit rating agencies, right? They're looking at them, they're saying, okay, SAP has this rating, Fitch has this rating, it's above my threshold, it's A- or better, it's okay, I can use them and think, done. Whereas actually a lot of these corporates who are out there issuing paper also have pretty strong credit ratings from these agencies. And so from a risk perspective, if they're rating it as an A and there's a bank rated A, then it's looking pretty good. And as I say, it's offering diversification, which is the key thing. A risk which is going to affect a corporate, if you're lending money to that corporate, isn't necessarily going to affect that bank, but a risk that bank may well then affect that whole banking sector and have contagion. So of course there is risk, and you should put appropriate measures in place to mitigate that, i.e., you may have a monetary limit on how much you can place with other corporates, or indeed, again, a credit rating limit that you have to, they have to be A rated or better, whatever it might be. But I do think there's a place for buying corporate paper directly. And I touched on it just a second ago, but in the US market in particular, this is something which is much more routinely done. Other corporates are appointing, short-term portfolio managers and managing cash in-house and using CP because it's a valuable tool to diversify, but also to get an attractive yield and an attractive risk-adjusted return given the credit rating of those institutions. So it's something like that. Direct securities purchases in the US is much more common than it is in Europe, and you've got to sort of ask why. And I think the answer rather is there's just the market access there. That there is the way of doing. There are ways of doing it. Whereas here and across Europe, it's limited, but it's growing, and I think that will be something which will be really interesting to see over the next sort of few years as it grows.
It's a lot of reliance on the credit rating agencies there. I mean, I guess with banks, if you're getting your liquidity from a bank, then you kind of only have to watch the financial sector, right? And to see how is the financial sector doing. That's kind of indicative of the economy overall, and people kind of understand that a bit better. When you start going into corporate papers, as a treasurer, do I need to start taking into account, okay, yeah, Fitch rated them an A-, but how is the overall trucking industry doing if I'm getting a logistics company's papers? Or how is the overall software space doing? Or what? You have all these other industries you need to start watching as well, right? Does that not make it far more difficult?
So I think it's a really good point. Reliance on the credit rating agencies. And if you look what happened with Credit Suisse, I can't remember the exact dates, but it took, it was very close to the UBS takeover that they actually got downgraded. So, unless you were looking at the CDS rates, which were blowing up, 6 months prior, then really you might not have pulled out of Credit Suisse if you were purely relying on those credit rating agencies. So do I think a corporate treasurer is ever going to place, 50+% of their liquidity with other corporates? No, that's not going to happen. But a lot of corporates are already exposed to CP by their money market funds. Money market funds are purchasing these instruments. So they already are doing that. If they had a way of buying those papers directly, could they place an element of their portfolio in them? I think so. You certainly wouldn't place a great deal, I don't think. But you would probably use it, because you're right. It's impossible for a treasurer to stay on top of the trucking industry, the logistics industry, and all of these things, as well as doing everything else that they do. And to a certain extent, that's why there is the reliance on the credit rating agencies, because treasurers simply don't have the bandwidth to, have a team of credit analysts who are working away in the background and looking at balance sheets and whatnot to do those.
Because the complexity of your counterparty risk just goes up as well with it, right? Because of these industries. And we did an episode where we talked about credit rating agencies, and I think if you're sub-investment, you're only getting reviewed every 6 months, and if you're investment grade, you're getting reviewed every year. And a lot can happen in a year, as we've seen in the last couple of years as well, right? So it's...
Exactly. And there are some tools out there which are trying to sort of change this and to allow for better transparency. And I think treasurers should be aware of some of those, because they are really interesting. Because it's certainly a space where at the moment it's a little bit opaque. Like you say, they don't get updated quickly enough. They're a little bit backward looking rather than forward looking. And I think there are tools out there which can really help.
I think we covered one in our AI newsletter, but I can't actually remember the name of it.
The credit rating.
No, it was on counterparty risk.
Yes.
It was an AI which was scouring the news for a
specific industry and will tell you, because of what's happening, that's a predictive model.
Yeah, and giving
correct. I don't remember the name of it.
We'll put it in the show notes after 100%. We find it, and we'll do that. But it was an interesting company indeed that treasurers could indeed be looking at it. So given all of these challenges, diversification is indeed. So you also mentioned that your money market fund already has these CPs, but probably at a percentage or a diversification which you can't control, right? You could always go into the market for other money market funds and compare different ones and say, okay, this one's a little bit more risky, this one's a little less, and then work accordingly. But then having that flexibility to do it yourself, that's kind of what you're advocating for, right? Which is that you're going to get it anyway, and it's baked into the money market funds. Doing it directly would probably be a little bit cheaper. You probably save on some of the fees, but also allows you to have the flexibility on how much you're diversifying, right?
Yeah, I just think it's another way you can add an element of diversification to your portfolio. I think what's probably more relevant and more comfortable for treasurers is being able to access governments or SSAs, so super sub-sovereigns and agencies. So establishing those connections via whomever may be able to provide it is really important. So rather than taking bank risk, you can take government risk, and rather than taking government risk, you can take agency risk or sub-sovereign who carry very high credit ratings, and are probably in most cases majority government owned, these agencies. And so I think, I'm not sitting here and saying all corporates should start buying loads of other CP. It's just another tool which, if you have the access to, you afford yourself that choice, that ability to access it. If you are in money market funds, as I say, you will have an element of exposure to it already. So, don't be so adverse to it. Would be my take.
It's tough to get a corporate treasurer to not be risk adverse.
It is about being risk adverse. It's about diversifying. That's what it's about. It's about not being purely exposed to the financial sector. Maybe you start with getting access to government bills right before that, and SSA paper, and then you think about that corporate risk.
Makes a lot of sense. So in that order of priorities that you highlighted earlier, capital safety, liquidity, yield, you put in diversification in there as well. Have those priorities changed over the last few years with everything that's been going on? Or I don't know if the right question is, have the priorities changed, or rather have the importance or the weighting of each of those priorities changed at all, in your opinion?
Yeah, I think it comes back to what we were talking about earlier. I mean, I definitely think it still runs true. Security, liquidity, yield, and diversification baked in there somewhere as well. In that order, the importance of cash can't really be understated. The importance of being able to pay your staff, pay your vendors, keep the business running, is the utmost priority. So capital preservation, I think, is always going to be number one. What has changed is we have this thing called, interest rates now. 2-3 years ago, we didn't have those. And it made no odds if you invested in an overnight vehicle or in a 3-month term deposit or in a 6-month investment or whatever it might be. Your rate of return was not material, right? It wasn't making a material difference to you. And it wasn't that long ago, right, where we were in euro negative rates. So, things are looking very different now to how they were. And it does take a little while to sort of, I think, change the mindset that actually, if I do term out, there are significant material differences to be made. So I don't think the priority has changed. I still think it's that order. That is how a treasurer should think and does think. But the benefit of terming out has seriously increased and add to it. And so now, a CFO is going to be looking at their cash portfolio, seeing what they've got. All right, we're all overnight. We're only in a current account, or we're only in a money market fund. Is there something else we can be doing to improve the returns on this cash and offset, as we were talking about earlier, the impact of inflation? So I think just to sort of come back to the question, same order, definitely of priority, but it's now got this added element of actually I can add material returns to my cash.
You said something else very interesting here, Oscar. You brought in the CFO. So whilst we focus on the different options for the treasurer, as cash is becoming emperor, if I may do the pun with cash is king, has the importance of cash become so big that now CFOs and even maybe boards, in your perspective, are looking into what type of investments are made? Because now it's not about, whether we get 0.2% or 0.5% on our excess of cash. Now we're talking about 10 times the amount. Is the importance of cash becoming so big that it's looked upon by higher up people in the hierarchy?
Definitely. And just to touch on your point there, cash is emperor, I really like it. I mean, I heard cash is trash a little while ago, but I don't think that's ever true, right? It's never trash. And I think emperor or empress or king or queen is definitely right. And yeah, from my experience, it's certainly taking more attention from top of house. I think talking to treasurers, there's a little bit more impetus on, not only keeping it safe and making sure it's appropriately managed and from a risk perspective, but also thinking about how am I making it work better for us? Because, like I say, the environment we're in now is just hugely different to what we were in a few short years ago. And one risk we haven't touched on much is that liquidity risk, because of course, you can tie up cash, but if you're in a vehicle you can't unlock at all, there's an element of risk there. But of course, you can also be in maturity transformed vehicles like a money market fund where you're getting same day access, but actually your cash is spread across instruments from 1 day all the way out to 12 months and sort of everything in between. Although you get same day liquidity on 100% of your cash, and so does everyone else. So there is a degree of risk there, because if more than 20% or more than 30%, depending on where the cash is managed, want to get their cash out, they're not going to be able to. And then there could be a run on the fund. And so this is something that needs to be thought about. And it is thought about, there's been various different sort of fees and gates have been implemented into the money fund industry to sort of offset this risk. It does seem to be changing all the time with where we are. But it's just another element of risk that people need to be thinking about when managing cash. But look, I definitely think cash is top, perhaps not top priority, but it's certainly up there, and certainly is cash is emperor or something like that.
Getting there. I think according to recent surveys, cash flow forecasting is the number one priority of CFOs and treasurers. So not directly, where are we going to invest our cash, but pretty close to it.
Yeah, and I think with cash flow forecasting, right, if you have that, buttoned down, that then leads to the ability to then manage cash better. It means you can invest it further out. It means, right, I know I'm not going to need this pocket of 50 million for the next 3-6 months. I can go and find out where I can place it in a cash vehicle to get a higher return, because I know I'm not going to need that. It's cash flow forecasting is an interesting one because it always will come back to, I think we talked about trash already, but garbage in, garbage out, in terms of cash flow forecasting. So these tools are great, but it's all about getting the right data. And if treasurers can get that right, get the right inputs from their various different teams across the world and everything, and then they can get a great sight of where their cash is and what position they are in their cycles, and then they can manage it more effectively, then we're on for a sort of a golden ticket, if you like.
100%. Something you brought up earlier is the difference between the US and Europe. Could we dive a little bit more into this? Like, if location plays such a big role in short-term investment decisions from treasurers, from your perspective, what are the main differences in terms of markets and landscape between the US and Europe? Mm-hmm. And therefore, what are the consequential options for treasurers between those two regions as well?
Yeah, definitely. I mean, there's a few key ones. I think, and look, I'm not sitting here saying I'm an absolute expert and I know, exactly what every US treasurer thinks compared to every European treasurer. But broadly speaking, I think US treasurers maybe are viewed slightly more as a value add sector, in that, you can grow the business. So you take this cash and you make it work harder, you invest it. And that's why these short-term investment portfolio managers are coming in and they're actually managing the cash more like a portfolio. It's why seg mandates are more popular over there. So people are going to asset managers and saying, here's a big pool of cash, look after it for me, manage it within these confines or what have you. We have those in the UK and across Europe, but it's not quite the same level of popularity. So I think that's one thing. In the UK and Europe, it's viewed as more about, protecting that treasure, protecting the cash and making sure it's there for the people who need it. And okay, if you can get a bit of a return, then that's great. Obviously, what we've just talked about is that that's changing slightly, and I think it will continue to. But yeah, there's certainly a difference in that respect. And then, we touched on it again earlier, but it's about the access the US treasurers have, and there's much more openness to direct security purchases. So buying US T-bills or investing in US government bonds, further out the curve. Or, as we talked about, buying corporate paper or SSA paper. There are plenty of market makers out there who are doing this in the US, and it just seems more commonly done than what we do here in Europe. And I think they're sort of the two of the key differences that I sort of found over the last sort of few weeks being over there at the AFP and whatnot. Things are fluid, and of course they vary from company to company. You have some companies here who are really looking for that higher return in their cash portfolios, and then you have companies who don't care. So there's a cultural element both within the region they're in, but then within the company itself.
Oscar, one of our favorite exercise on the Corporate Treasury 101 is to chase down and break acronyms to make them understandable. We've touched upon quite some that we've already touched upon in the podcast, so it's fine. But you mentioned SSA paper. Could you explain what that is, please?
Yeah, look, so it's just a broad term for the supras, sub-sovereigns and agency world. So these are exactly that. So they're supranationals, which are government-like organizations who go out to market and raise debt. So they might do that via issuing paper, issuing bonds, and you purchase these typically via a broker-dealer. And so these often carry a high credit rating. So because of their ownership structure, they might be 60% government owned, 70% government owned, or they might be 100% government owned and raising debt on behalf of the government. So it's another place where treasurers can diversify away from purely financial risks or purely corporate risk or wherever else you might be spending cash. And sometimes people just refer to it as the agency market.
Yeah, okay.
Super interesting. Learned something new today. Oscar, thank you so much. Clearly, it's super interesting field. I think there's a lot going on in that specific space, especially with everyone frantically running around to figure out what they're going to do with this high interest rate environment, or at least what's the best thing that they can get out of it, right? I want to touch a little bit on TreasurySpring, which is the organization that you're from. And so what do you guys offer to corporates in terms of short-term investment solutions?
Yeah, so we are a bit different. We do offer something a little alternative. So we are the only institutional cash platform that allows businesses to access the very best in cash products when you think about risk-adjusted returns. So we allow businesses via one onboarding, one KYC process to access over 75 different counterparties. So those counterparties range from the banks we've mentioned, the SSAs, governments, and including some corporates, more nascently, that's that corporate field. And importantly, what we do is we allow for repo. So allow businesses to access the repo market. So we've built the infrastructure, built the connectivity, built all of that pipe work so clients can come into our platform and access secured lending products to these banks. And we believe that these repo products offer some of the highest risk-adjusted returns available in the market. So we have around 300 corporate treasurers using us at the moment across a variety of different industries. So whether that be large listed businesses or financial institutions or smaller, medium-sized enterprises. And we've seen over $75 billion worth of issuance via our platform. And really, the need for TreasurySpring was sort of forged in, when you think about hedge funds and you think about banks and other very large financial institutions who are very sophisticated, and you think about how they manage cash, what are they doing? They're thinking about cash as a proper investment. And so they are thinking, right, where is my credit risk and what is it? And is there a way to lower it? And the way in which most of these businesses do it, most of these large, sophisticated organizations do it, is via that repo market. So they don't only take that bank risk, they take a collateral, so they take a position of securities, whether that be high quality liquid assets like government debt or what have you, or a broader basket of debt. This is then posted to the tri-party agent. The tri-party agent manages that on behalf of the client, and then should that bank go bust, this basket of collateral is then liquidated and clients get their cash back that way. But accessing this product, very difficult, time consuming, expensive, all of the above. And what we've done is enabled them to do it quickly and easily.
Typical. And that's your specific USP, is the getting access to the hard stuff easier.
Exactly right. So I would say, we have probably about a third of our assets under management is in repo right now, maybe another third in SSA, and then the rest in direct government and corporate and unsecured bank risk. Something like that is probably the split. But what makes us different is we've broken down the barriers to access repo. No one else has done that as yet. So what we're doing is enabling businesses to manage their cash in a more efficient way very easily, without the usual heavy lifting, the usual onboarding and everything.
And have you seen that business model that you offer is a lot more favorable in the current interest rate climate? And if so, what advantage do treasurers get from that? Yeah,
definitely. So we offer anything from 1 week all the way out to 1 year. And the way in which we deliver that is via fixed term funds. So these fixed term funds offer exactly that. So it's a defined credit risk to a single obligor of the client's choosing for a defined period of time. And the cash is always held to maturity. So these vehicles are self-liquidating and there's no mark-to-market volatility. So you put your cash in, you get your cash back plus the level of interest that was agreed. And sometimes that can be secured. So if they've chosen a repo, sometimes it can be government. So it might be a UK T-bill or a French government T-bill or Dutch government T-bill, whatever it might be. It might also be some SSA paper. Now, what's different about what our platform is, clients on board once, they KYC once, and they have access to that full curve. So they can keep their cash relatively liquid in a 1 week repo product if they like. They can keep their cash out 3 months, sort of keeping it under cash and cash equivalency rules. Or if they want to, if they think we're getting to terminal interest rates, they might term it out even further, go out to a year and make the maximum use of that value. I think, with any cash product which is offering term, having very, very low interest rates means that, terming it out isn't that valuable. So of course, rising interest rates, the opportunity cost of doing nothing with your money has increased massively. And so now clients are able to do that with us via one platform.
Super interesting. And are you managing these funds yourself, or are you sort of like a broker for multiple funds out there?
So look, good question. So we're not a broker. We're out there originating these deals. So we have the relationship with the underlying banks, with the underlying SSAs, or if we're using a broker dealer, with the broker dealer as well. So what a client does is they come into our platform. They'll choose from a menu of short-dated fixed income products. So whether that be a 1-week repo or a 3-month SSA paper or a 2-month government bill, they'll then select that. We then, on the other side of that, go away and purchase the underlying asset, and then their client is issued a fixed term fund, which is their fixed term fund and their fixed term fund alone. And so it gives them full legal segregation from everyone else on the platform in other products. So their credit risk is only with the obligor that they've chosen, and there's no commingling whatsoever. So there's no one else's cash in there. It's their cash and their cash alone. And also there's no maturity transformation. So if I'm in a 1-month fixed term fund, the underlying asset is a 1-month asset, which means there's no liquidity risk in the sense of mark-to-market volatility. What you get is you put your cash in and then you receive a cash back plus interest upon maturity.
Amazing. That sounds like something that could be definitely of interest. What's required, though, on the implementation side of things, Oscar, for a corporate? Like, do they access your dashboard or your solution from the cloud? Do you integrate with the TMS? How does this whole thing work?
So it's a simple desktop website. So simple API. So clients log in. They'll they log in passwordless entry using Google or Microsoft 365 or whatever it might be, and then they've got access to all of those different places for cash. Now, in terms of integration, clients we produce reporting which we plugged into TMS. So clients can see within their TMS where their holdings are, and we produce monthly statements and everything like that as well. We plug into other portals in terms of reporting if clients want to see them within those. So there's no complicated integration needed. There's no TMS implementation process or anything like that. This is from a technology standpoint, in terms of actually using it, it's very straightforward, very, very easy to do.
And if you don't mind me asking, Oscar, so how does it work? Is it the corporate paying for the solution, and then there is like some bits on the investment? Is it on the bank side? How does it work exactly, if you don't mind sharing?
So a client invests and they get a rate of return, which might be, let's just say 5%, and that encompasses any costs, fees that we have. So we don't charge an onboarding fee. We don't charge a usage fee. There's no minimum balances required. So if a client likes the look of a price and they invest, then they'll do that. And then that's where we make our money, within that transaction already built in. So if a client sees 5%, client gets 5%.
Awesome. Oscar, thank you so much. Anything else you'd like to add to short-term investment, the landscape, what treasurers can have and choose among the different options, or TreasurySpring even? Did we cover everything, or anything you'd like to add?
Yeah, look, I mean, just in terms of short-term investments broadly, right? What does a client want to be thinking about? They want to be thinking about their credit risk. So what is the institution they're placing it with? So are they looking at credit rating agencies? Are they doing their own in-house analysis? Are they using all of these tools we touched on earlier? So they want to know where that cash is and who it's with. They want to think about, do they have access to alternative homes for cash? So something like the government or SSA, which we've touched on, or even accessing corporate paper, which might be a bit of a stretch for some treasurers, but having somewhere where they can diversify not only across institutions, but also across asset classes, sectors. And then they might also want to think about, how can I take collateral? So how can I access a repo so that in the case of a default, I have that security. So is there a way in which I can do these things? Because, again, it comes back to stripping it back. What is cash management? It's investment. You're making decisions with that cash, and there is risk to that cash. I think we're in a really challenging time. We're at high levels of inflation, high interest rates, bit of a guess to try and work out where terminal rates will be. Are we in higher for longer? Are we going to see it cut soon? So it is an interesting time. But I think it's, I think really that's how clients should think about it. And, one instrument that offers sort of that security is repo. And at the moment, what we're doing is breaking down the barriers to enable easier access to it. It's as simple as that.
Awesome. Thank you so much for that. Oscar, if our listeners would like to know more about you or TreasurySpring, where should they go?
Absolutely. So TreasurySpring.com is our website. We're also obviously on LinkedIn, and we're regularly posting on there. Feel free to reach out to me directly, ocoyle@treasuryspring.com, and we'd be more than happy to connect. Look, we're at all the conferences sort of on the circuit you might expect. We're going to the ATEL later this month in Luxembourg. It may be before this podcast is out, but we're there. We'll be across Europe at the DACT in March as well. And then, of course, the usual conferences of the UK, the ACT, ESG conference as well.
Fantastic. Absolutely awesome. Thank you so much, Oscar.
Thank you both. Cheers.